Today, as we continue to work through Chapter 1, Uses of Accounting Information and Financial Statements, we will be looking at Objective number 5. In Objective 5, we will define financial position, state the accounting equation for a corporation, and show how both are affected by various transactions. Let's start by looking at our accounting equation. In our accounting equation, we look at economic resources or assets equaling equities. Just like in the beginning of the year, in the first semester, we had the accounting equation assets equals liabilities plus owner's equity. We will define our equities a little bit more in a few minutes. But let's look at our economic resources for a moment. Our assets. These are anything of value that the business owns that can be used to benefit future operations of that business. We can break those economic resources or assets into basically two broad categories. Monetary items, such as cash, accounts receivable, and then what we would consider to be non-monetary items. Those non-monetary items can be also broken down or further broken down into things that are physical and items that are non-physical. Physical non-monetary items would be things such as inventory, land, building, and equipment. They have physical substance, and then non-physical things or non-monetary, non-physical items would be such things as patents or trademarks, things that are something that you can't touch or feel but do have value to a business. So for instance, if a computer software company were to spend a lot of time and energy and effort to develop some sort of software, that software is something that they own the rights to, they own it, but it doesn't have any physical value, physical structure. Let's look at now the other side of the accounting equation, the equity side. Our equities can be broken down into two categories, creditors' equities and owners' equities, just like we looked at during the first half of the year. Our creditors' equities, or liabilities, are the present obligations that a business has. They're the things that they're basically what they owe money for. And so our accounting equation can be broken down into, just like it was in the first half of the year, our assets equal our liabilities and our owner's equities. Our financial position shows the values and the relationships of our business's economic resources, its assets, and the claims against those resources by its owners and its creditors. So its liabilities and its owners or stockholders. So how is the owner's equity different in a corporation than it was in a sole proprietorship? Sole proprietorship is what we spent the first semester looking at. And now we're going to look at how the owner's equity is different for a corporation. Owner's equity represents the claims by the owners of a business to the assets of that business. Owner's equity is essentially the residual equity that remains after deducting the liabilities from the value of the assets. If a business sold off all of its assets, the value of the assets goes to the owners after paying off the creditors. And if we look at the accounting equation just phrased differently, we look at owner's equity equals assets minus liabilities. How is the owner's equity different in a corporation? When we have our owner's equity, when we have our assets equaling our liabilities, now instead of just saying owner's equity, we're going to focus on the stockholders as the owners. Stockholders' equity. We'll phrase it as SE. And the stockholders' equity consists of two primary categories of stockholders' equity. There's what we call contributed capital and retained earnings. Contributed capital is the amount that the original stockholders invest in that business, whereas retained earnings is the accumulation of the earnings of that business over time. So when the business makes a profit, the amount of the profit that is staying within the business is what accumulates as retained earnings for that business. This is slightly different than what we looked at in the past when we dealt with sole proprietorships. If you remember, the sole proprietor was considered one with that business. So the retention of any sort of profit in the business itself stayed within the owner's capital account, if you recall. Now, because there's a distinction and the stockholders are separate really from the business itself, the retention of the earnings of that business is separately accounted in a retained earnings category. So let's look at how businesses go about accumulating or retaining their earnings. As we learned in the first half of the year, businesses sell their products or services. They generate revenue or sales. Sales or revenue, as we learned back in the first half of the year, have a positive impact on the equity of the business. In this case, we're going to say in the stockholders' equity in the category of retained earnings. So, revenues have a positive impact on retention of earnings. On the other hand, we have our expenses. Our expenses have a negative impact on retained earnings. They're the amounts of money that the business pays out to operate its business. Additionally, some corporations may provide dividends to their stockholders. Dividends are a form of return to the stockholders. So, we can say that revenue minus expenses equals net profit or net loss. If there's a profit, which means that revenues were greater than expenses, that positively impacts the retention of earnings. If revenues were less than expenses, meaning expenses were greater than revenues, there would be a net loss, just like we learned in the first half of the year. A net loss would be a reduction or a deduction from the retention of earnings. If a business decides to provide a return to its stockholders in the form of dividends, that would essentially take net profits and subtract some of those profits and give them to the owners or stockholders. So from a definition standpoint, dividends are the distributions of the assets of the business to its stockholders from past earnings. Usually, this dividend is done in the form of cash. Let's look at some essential formulas for this chapter. The accounting equation. Assets equals liabilities plus stockholders' equity. Stockholders' equity can be further defined as contributed capital plus retained earnings. In terms or by way of calculating our stockholders' equity, we can look at the beginning stockholders' equity, whatever that might be, and add to it our net profit or subtract from it our net loss. Add to our stockholders' equity any additional contributed capital that we might have during that period. Subtract any dividends during that period, and then the balance would be our ending stockholders' equity. In looking at the beginning retained earnings, or the retained earnings, we can say the beginning retained earnings balance, whatever it was at the beginning of the period, we can add our profits or subtract our losses and subtract any dividends to give us our ending retained earning. So these are the essential formulas that we need to keep in mind for this chapter during the remainder of the year. On pages 19 through 23 in your textbook, you can review the various transactions of a corporation and see how they affect the financial position of that corporation. Define financial position. Please write your answer on the corresponding page in your notes. And that concludes Objective 5 for Chapter 1 in Financial Accounting. Please answer the 2 questions relating to Chapter 1, Objective 5, and click Submit to submit your responses.